everyone, and welcome to 2026. 2025 was filled with drama and followed by bouts of episodic volatility. The way 2026 has started, we should see more of the same. While all of these events have been going on, there has been quietly some change in the financial markets opportunity set. There is a broadening of asset class, regional, sector, style, and income opportunities that make investing success less reliant on just a few places. We see this as exciting development and will discuss how we have positioned portfolios to capture these changes. Let's review 2025 performance. Despite all of the political noise, the markets were mainly driven by their usual main driver, fundamentals. There was strong corporate earnings driving stocks. The international markets outperformed the U.S. markets for the first time in 15 years on the back of strong earnings, stimulus, and currency appreciation tailwinds. It wasn't just stocks. The U.S. bond market had its best performance since 2020. Interest rates trended lower. Last year, tariff policies, conflicts, and artificial intelligence dominated the investing world. As we look ahead, they will continue to play a role, but there are changes in trade, currency, and central bank policies and government stimulus programs that are changing the landscape. There's been a lot of discussion in economic circles that the U.S. is in a K-shaped economy. A lot of facts support that argument, and it looks to continue in 2026. A K-shaped economy describes a post-crisis recovery, where different parts of the economy and society are performing at sharply diverging rates, forming two arms of the letter K. The upper arm, going up, you have sectors, companies, assets, and people that benefit from the recovery, and in many cases are wealthier than before the pandemic. This includes investors in technology stocks, big tech companies, the luxury sectors, high-income professionals, and asset owners. The lower arm, going down, have sectors, small businesses, and people that continue to decline or stagnate even as the overall economy appears to improve. Examples include the hospitality and travel industries, many lower-priced retail outlets, low-wage service workers, small businesses, and many middle-class and lower-income households. We are watching closely as farm and small business bankruptcies have increased substantially, and delinquencies are trending higher for consumers. This can all lead to a stagflationary environment, where we have higher than normal inflation and slowing growth. We've prepared for this type of environment by increasing income significantly from our fixed income investments and our hedging strategies. All investors' eyes are on the job market for clues about future central bank interest rate moves. The jobs picture is currently the weak link. As the chart on the left shows, the U.S. economy has barely added any jobs since April. Piling on, in the chart on the right, we see the unemployment rate trending higher and hourly wages steadily falling. It's no coincidence that businesses became very cautious right after the tariffs were announced in April. Rightfully so. They are forced to plan in a period of uncertain tariff policy and government policies in general. Another economic indicator that is a big focus for the markets and central bankers is inflation. As we know, and shown on the chart, inflation has fallen from its peak, but remains stuck at an annoyingly high levels. Tariffs obviously have played a big role in higher prices. Don't be fooled by some of the benign inflation reports. Companies took measures to combat inflation in the 2025. We saw massive imports to get ahead of tariffs, and companies absorbed about 70% of the remaining impact. That appears to be about to be changed. Number one, import effect is fading, and number two, companies have announced they will begin passing most of the tariff costs on to consumers. There is hope on the tariff front. The Supreme Court is about to rule on the legality of tariffs, and over 1,000 companies have sued the government regarding tariffs. However, the Trump administration says they may have workarounds to maintain the tariffs. Either way, we have positioned portfolios to further hedge against inflation by adding hedging strategies and income, because bonds alone are not the best inflation hedges. Another big story is energy demand and generation. After 20 years of flat electricity demand, the U.S. now needs to meet new demand from data centers, EVs, and electrification of commercial, industrial, and residential heating. While U.S. electricity generation grew by 2% to 4% each year from 1950 to 2006, during that era, 70 to 90% of new capacity additions came from a small number of large coal, nuclear, and gas plants. Whether the same pace can be maintained today is another question, particularly given the associated shortages of skilled energy labor and the government's crackdown on energy projects. The good news is companies are not waiting on the government. They are working on funding their own needs, and new technologies are cropping up. This is a global story and why we've added infrastructure investments into portfolios. While bond investors, particularly in the U.S., had a very good year, we expect U.S. bond markets to face a tougher 2026. We forecast lower returns as interest rates do not fall as much as in 2025. As the chart shows, the Federal Reserve expects to cut rates once in 2026, and will most likely happen in the second half. However, bond investors and strategists are expecting 2 to 3 cuts. Also, continuing fiscal structures causes governments to issue plenty of debt for funding needs. In addition, corporations are expected to issue a record amount of debt in 2026, so supply alone will be a headwind and keep intermediate and long-term interest rates anchored at higher levels. It is why we currently do not have many U.S. Treasuries in portfolios. As you can see on this chart, the interest rate environment has shifted, and a lot of countries are offering yields that are very competitive with the U.S. As you can see on the right, the emerging markets are offering some of the best yields. In many cases, the emerging market economies have less debt and rising currencies. That is why we've expanded our emerging market bond allocation throughout 2025. We have coupled that with using other components and regions of the fixed income markets and our hedging strategies to accomplish our 3 main goals for our non-stock allocations. Number 1, to reduce downside risk. Number 2, enhance diversification. And 3, generate higher income. Generally favorable macroeconomic conditions are providing a positive backdrop for corporate earnings in 2026. Consensus earnings estimates for the new year are looking brighter as government spending fuels industrial activity, and the new tax bill is favorable for corporations. As the chart shows, companies based in emerging markets are expected to enjoy the strongest earnings growth, rising 17.2%, while the United States comes in just over 14%, and Europe slightly above 11% based on earnings estimates. In Europe, Germany has introduced a bold infrastructure stimulus, roughly 12% of the country's GDP, aimed at boosting growth, spurring competitiveness, and strengthening regional security. These initiatives provide opportunities for a range of industrial company systems, as well as industrial software developments. In Japan and other Asian countries, improving corporate governance is providing a tailwind for companies as they adopt structural reforms and shareholder-friendly initiatives, like accelerating share buybacks and paying higher dividends. These are some of the reasons why we increased our international allocation last year. We see this as a longer-term trend. Looking ahead, there are tailwinds that should drive earnings growth and support market gains beyond the technology sector. But ultimately, what's going to matter is corporate fundamentals and earnings growth. We are excited about the expanded opportunities set in the financial markets, but aware that the market pullbacks will occur. We are also aware how episodic volatility is on the rise and the global geopolitical and economic climate are changing at a faster pace. We have adapted and enhanced our scenario testing capabilities to allow us to do the most important thing in investing: prepare ahead of time for what happens next. Please reach out to us if you have any questions or we can help